After some weeks, probably about a month of it's the holidays, nothing much is happening, we get two huge housing drops. Huge monsters. First one, let's talk about what dropped yesterday. Chairman Powell making a video.
Criminal probe into Chairman Powell for his dealings with the renovation of the Fed building and policy-making decisions from meetings that came out of June. I think there's a pretty good chance this investigation is going to go the way of the James Comeys and the Letitia James. We'll see. He clearly came out and said, I'm not going to be intimidated by this.
Really remarkable statement for the sitting chairman of the Fed.
He knew this was coming. This was prepped. I think he was tipped off that there was going to be an investigation launched back in June when there was that. Remember, there was a huge amount of pressure on him during that time. I think he's been prepared for this. If there was something shady done there, we can't have that. He'll be out. I just seem to not think that it was anything other than him just not wanting to. He wanted to maintain Fed independence.
I do think that a lot of people were really shocked by the amount and cost of this renovation. It's a large number, $2.5 billion. So when you combine that kind of headline number, I'm not going to sit here and say if it's legitimate or not legitimate. I don't know. I do know that renovating historic buildings is very expensive. There's no doubt about that. Does the Federal Reserve need a $2.5 billion building?
No.
There you go.
No.
They don't need it. But were they authorized to have it?
They definitely
don't. They were authorized. Now, in the management of that $2.5 billion, is there crime? Could be. I don't know.
We're
going to find out. But the process of finding out is going to take a lot longer than May, which is the end of his chairmanship.
I'd say the chairman of the Fed, okay, embezzling money out of a renovation project for a Fed building just kind of seems like a ridiculous thing to even imagine. Not to say that it couldn't happen, but you would think, in America today, with our institutions, we wouldn't have somebody be so stupid that's in such a powerful position.
Right, because that could be paper trail. There's plenty of people.
Oh,
if you're the chairman of the Fed, there's plenty of people willing to bribe you. Plenty of foreign governments willing to bribe you in cash.
Yeah, I think it's just pretty far-fetched. Okay, so next thing, this is going to be the much more impactful thing. Okay, for us, for anybody in the housing market this year, anybody that's got a mortgage, okay, Fannie and Freddie's money going to be used to buy more mortgage-backed securities. Now, we've talked about this a little bit before, but going back to the COVID days, Fed lowers interest rate to zero, which had an impact, okay? But the major impact was the bond buying programs. Bonds and prices have an inverse relationship. So you think about this. If there's a huge buyer of something, the price goes up on that, right? Yep. Because it's supply and demand. So if the price goes up, the yields go down. The interest rate goes down. So if there's a huge buyer out there, $20 billion a month, which I think during COVID we were doing $40 billion. $20 billion is still going to move the needle. That could have a significant impact on rates, and already has.
On Friday.
Immediately.
There was a pop. I haven't seen what they're going to, market's not updated today, but we're expected that this is
flat. It's flat from where it closed on Friday.
Expectation is that this will hold, that this will be a temporary to permanent eighth to a quarter improvement in rates until the end of the buying operation. Not opposed to, in theory, one of the better things that you could do. I am concerned about the fact that this $200 billion does not come from cash and cash equivalents at Fannie and Freddie. This wasn't just $200 billion just laying around. Nobody was doing it. The amount of that money is only about $10 billion.
So they had $10 billion in cash, and then they had another $200 billion that they could put against assets that they own.
They have more than that. They have about $350 billion in total assets of mortgages that they own. So for direct lenders.
So of $350 billion, they're going to leverage $200 billion.
300 to 350. But yes, they're going to leverage $200 billion to get more mortgages.
Yeah.
The wisdom of that, a little hard to say. I don't think that of the things that you can do to stimulate the housing market, this isn't the worst. I would rather a quasi-public corporation do this than the Fed. Is it inflationary? A little bit. But at the same time, a lot of people that are critiquing this, I don't think they understand the current state of the housing market, where there's still a lot of yammering about housing supply. Supply is pretty good right now.
It's the highest since 2013.
We've got quite a bit of inventory sitting. As far as the time of deploying the strategy, this is not a terrible time.
No.
Should move the housing market a little bit. We'll have some real estate activity.
It's quantitative easing.
Yeah.
Right. It's definitely stimulus, and it's inflationary, but it also has the impact of lowering people's monthly on if they've got a mortgage over the last 3 years. If you refinance and your payment goes down, that's deflationary from a payment standpoint. So this could be a good. The question is it really going to move the needle? We don't really know. It's going to help, but is it going to be dramatic? We're not quite sure. The 10-year Treasury, which is not being bought at this point, keeps floating a little bit higher too. So there could be some upward pressures there.
Because we've moved from about to close to 4.2 this morning.
Yeah.
Just drifting upwards over the holiday break. We thought that after the holidays were over, I thought last that we would see some reduction in 10-year, simply based on that traders are getting back to work, and you can't really infer much, but it appears that this higher 4.15 to 4.2 level a little sticky.
Yeah.
So, and that on its own is about an eighth worsening. Has been a little more than offset by this big boost of bonds. What we have seen is a compression in the spread between mortgage-backed securities and 10-year Treasury.
That's the main thing that's helped rates be lower is
even when 10-year Treasury has drifted over the past 3 weeks.
The difference between the MBS and the 10-year Treasury is quite a bit narrower than it was in previous years.
And I'm curious, obviously very much so in previous years, I'm curious where it stands historically. I imagine it's pretty close to some longer term lows, not like hugely longer term, but I have to imagine it's fairly narrow right now.
It's getting narrower and narrower by the day. So, which is going to help mortgage rates. Yeah. And hey, if mortgage rates come, I think we're going to be looking at rates in the 5s this week. Mm-hmm. It's been a long time since we said that. I think we had a blip in the end of 2024 where rates dropped in the 5s. I think it was about a week.
Yeah. So, I did a bunch of refis that week.
We did. So
doing a bunch of phone calls today.
We talk about this all rates. If you bought a house or taking out a mortgage, might be worth looking at. Well, it's again, we're coming back to that. This, if you got a rate in the high 6s or 7s, definitely look at it. But even if you have rate in the mid 6s, depending on what kind of loan you have, this might be a good time to look at refinancing. You might be able to save money. And general rule of thumb on refi, you could do it every 6 months. So, if rates come down again, you could always refinance again, just as long as you keep your closing costs. We do an analysis to see what makes sense on that. But you can essentially step down the rate. So the reason I say that, how many head fakes have we seen? Rates are good for 3 or 4 days, literally that period of time, and then they go right back up again. If you could do it, if you could save money, just don't wait on it. You could always refinance again.
This past September was like a week and a half. We had like maybe 2 days, and then we had something significantly advantageous. Because our goal is, I'm always hesitant to save someone less than 1%, right? In really large loan amounts, there can be but unless you're saving at least 1%, it's hard to make it worthwhile. For loan amounts under $250,000, you really need to be saving a little bit more than 1%. Because closing costs are just higher than they used to be, right? Yep. Structural closing costs back during COVID, you could easily get by with the structural closing cost appraisal waiver and lots of other things going on. Your total title, everything fees might be $3,000. Well, between more appraisals being done, because we're not exactly in the same called property inspection waiver environment as we used to be, and credit report fees, which are huge. I mean, back during COVID, credit report fees, $30.
Yeah, now they're
Some dollars.
yeah. So the costs have gone up a little bit.
Complexity of files, forcing processing fees.
Well, you could say too that the higher the loan, the less of a reduction in interest rate you have to have to make it worthwhile. So COVID versus now, there is a consideration to say that the loans are a lot bigger now than they were then.
Perfect.
If you have a $200,000 loan, you really need to drop that rate about 1.5 to have it make sense, in my opinion. But if you're at a $700,000 loan, 75 basis points could really be pretty significant. And just as long as we're keeping the closing costs under control. It's definitely worth looking at. Now, we can do an analysis on this with just a soft pull credit report, so we don't have to have a hard inquiry to get numbers. It's just, it is something that, if you got a mortgage in the last few years, it hurt to just take a look at it and see what you can do.
There's very few people that it wouldn't be beneficial to even look, because there's very few windows in the past couple of years that right now isn't better than or a good improvement over.
And I'll say it again: when we've seen these windows over the last 3 years,
they are small. They're tight.
Weeks. It's not a trend where it's like, hey, we got into the fives, then we're going to the low fives. It's like, nope, we're in the fives for a week and a half, and then we're back to the sevens again.
Get it while you can, y'all.
So, but I think these developments. This is all new. This is a lot of new stuff. There's a lot of stuff coming out from the administration. Ideas that can be interesting too. Capping credit card interest rates at 10% was mentioned a period of time. I love it. It also going to reduce access to credit. I mean, it just will. So, but it's an interesting idea. I mean, I like that it's being at the very least.
It's certainly good for the consumer. I don't know how far it's going to get on the field of battle with courts.
Yeah,
I mean, there's going to be an immediate injunction.
Yeah, you can't throw something out like that where they're used to making billions of dollars off of interest, and now they're not going to be making as much anymore.
But what Trump is a master at is setting the field of play, right? And the boundaries of what's going to happen further than presidents before him have been willing to do. So your opening bid, so to speak, is I'm going to do an executive order for 10%. What ends up happening is that credit card companies come to some sort of negotiated conversation with the administration, and
but overall,
so some things start improving.
And then I just wish they a 50-year mortgage.
And everyone, that total bust, and even Pulte has now backed away. We're not focusing on the 50. That's not a focus of our efforts anymore. That got said last week. It's just not a focus of our efforts anymore. Well, no joke, because no one liked
everybody.
It was ridiculous.
So it's gonna be an interesting month. We've already had a busy start to the year, so I think that's going to continue, and we'll keep everybody updated.
Stoked. Let's get it.